Hi, good afternoon, everyone, and thank you for joining us today in this important webinar. As you might have seen, the Reserve Bank has just reduced interest rates. And so these are unprecedented times for the country and certainly globally. COVID-19 has created really a crisis, but also a challenge at every level of our society. The purpose of today's webinar is to allow you to ask three individuals very particular questions, but to focus on three elements. Firstly, how our country and our government is faring in managing this crisis. Secondly, how our economy is impacted and what the future will hold for South Africa as an economy. And thirdly, the liquidity in capital markets and how one manages that. On that basis, as you all know, YW Capital spends much of its time raising capital, both domestically and internationally. And in times like this, the question that's often asked to us is, how does one still raise capital? And is capital markets still open, both equity and debt? No doubt, capital markets have slowed down and potentially on equity have almost closed. But it's times like this that one needs to realign companies and determine how to access that market when it is back. As we've seen from every major crisis around the world, post such challenges and such crises, there are always a significant amount of capital raising in the equity world. And we're also seeing a lot of continued activity in the unlisted space, particularly the pension funds, where they're moving into the unlisted space quite significantly. And one can still see a lot of raising of capital in that space. With that behind us, I think I'd like to just take the opportunity to introduce the three speakers we have with us today. And firstly, each of them will give about a 10-minute monologue on the crisis. We will then open the forum over to questions and answers, and then we shall conclude. Our first speaker needs very little introduction, Dr. Phosa. Matthews was instrumental in the liberation movement, as most of you will know. He was one of the first 4 South Africans that was brought back from exile to start the negotiation process into a democracy. And so his time with us today is quite critical in understanding challenges that have never been faced by our country before and how we fare through those processes. Today, he sits as a senior advisor, an accomplished businessman, and also a peacekeeper on the African continent. So his insights will be hugely helpful to see how we dig our way back out of this crisis. Our second speaker is Iraj Abedian. Iraj, which most of you will know, I believe was on TV this morning, on various radio broadcasts this afternoon, but was an economics professor at UCT. He has been instrumental and critical in developing policy both at a government level and a corporate level in South Africa. Was the chief economist to Standard Bank, the founder of Pan-African Capital, and is a leading voice in matters on policy, economics, and business. So Iraj, thank you for joining us. Our third speaker is Kgopotso Mosako. Kgopotso is not speaking to us in his position at the Reserve Bank, but will give us in-depth and insight as to the capital markets at this point and how South Africa is affected by it. He's a seasoned financial markets professional with over 20 years of experience and is one of the preeminent minds in strategy formulation, asset allocation, and portfolio construction, which is going to be critical as we rebuild South Africa post this crisis. With that introduction, I would like to hand over to Dr. Phosa. Matthews.
Thank you very much, Mesh, the panel and the audience, for the opportunity to look into ourselves here in South Africa and share with you. One need to take 1 or 2 steps back before C-19 hit us to be able to understand exactly where we are. Otherwise, you think some of the things that are caused by C-19, or else they were there before and they're still having an impact on where we are right now. The situation where we are before COVID-19 was that even before the downgrading by Fitch and Moody, our unemployment was still very high at 29%. There was always an argument and a complaint about the policy uncertainty in our market with regard to the land question, the position of the Reserve Bank, and many other issues which are creating internal debates in the political parties and in the ruling party itself, which all created a lot of uncertainty. There are a lot of problems around our state organs, like ESCOM, which is supposed to be very stable, but it's not. The South African Airways, South African Broadcasting Corporation, and many other key SOEs, as we call them. Our debt to GDP ratio is at 70%, which is very high, and one hope it doesn't go to 77% because then we'll be in a real crisis. And this economic contraction at 4% at the time, I think it's going to be worse now with COVID-19. The downgrading by Moody's and Fitch find us in that situation, and we are not out of it at all. If anything, T19 has exacerbated our situation. We are very lucky because when it hit us, and at the time when we thought we needed leadership, we do have leadership. Our president surprised everybody and rose to the occasion and took on this challenge. We all tried to say to him, toughen, toughen, toughen. And he listened. And he has brought this lockdown, which in my view has helped mitigate the situation. Just mitigating it. Because if you look at the graphs and the reports from yesterday from our Minister of Health and his team, our graph is not impressive. It's going up and up and up. There's no flattening of the graph at the moment in South Africa. If anybody tells you otherwise, they're lying. South Africans must be realistic and face the issue that the lockdown is helping, and it might still help if, in my view, is allowed to continue in some form or another. Otherwise, we're going to collapse into crisis of this epidemic. The epidemic has exacerbated the economic, the contraction. I think also the debt to GDP ratio. It has also increased the cost of borrowing for South Africa. I think it will obviously have a huge impact on unemployment. I see unemployment going beyond 30%. And of course, a lot of SMMEs just disappearing into thin air. And the big businesses, the tough ones will survive, but the smaller ones are going to have it very, very difficult. Which is an issue which is being raised right now in our market. The Sunday Times carried a big headline saying, save our economy, which creates a dilemma for the government, because while the government must fight with the pandemic, it's not going to be equal to the fact that the economy is suffering. There's going to have to be a balance between controlling the epidemic and allowing the economy to slowly return. I'm saying slowly, but there's no way it can be fast. And our government is expected to announce new guidelines as to how that should be done. The opposition, the Democratic Party, is talking about soft lockdown. There's a lot of linguistic creativity in the environment, but it's all aimed at helping to try and support the president to find solutions to difficult problems. There's obvious sectors like mining, which the government has allowed to continue to mine, to operate under conditions where health is stringent. I think the government should continue to look at other sectors like agriculture, which creates a lot of jobs, and investing internal capital in infrastructure will create more jobs and stability. The risk we are facing if we don't address both the spread of pandemic and the economy itself is that South Africa is potentially faced with social instability. You can feel it brewing in the townships, in the squatter camps where people are poor, they're sitting in their houses. You ask them to stay at home, they stay at home and do what? There's no food, there's nothing. That's the reality. It's not like in an advanced Western situation. So the government has to balance between controlling the pandemic, stimulating the economy slowly into some form of existence. It can never be normal now. Nothing will be normal. But to try and get it on its feet slowly, I call it a partial lockdown. People could use many other words, but there's no way what happened in the mining sector should not happen in forestry, in agriculture, and in other sectors, where there's a bit of a relaxation and the allowance of economic activities to continue. I see our government going in that direction. I see new investment opportunity in that situation.
Thank you, Matthews. Before I hand over to Iraj, if I could just ask, if anyone would like to ask questions, if you could use the Q&A tab on the bottom of your screens, and please do mention who the question comes from in your organization, if possible, and who it is addressed to. Matthew, thank you for that insight. I will hand over to Iraj now.
Thank you very much, and greetings, everybody. As Dr. Phosa quite aptly highlighted, South Africa came to face the COVID-19 with severe preconditions. We had all kinds of political lack of unity, institutional infirmities, and our economy was in a very muted space. And of course, the crisis that we face now has brought a global, regional, and national conditions for us, complicating our situation. Let's start with the globe. We know that the global GDP is going to be cut at least by half. The more the IMF, OECD, and global institutions apply their mind, the more they're beginning to raise the flag that perhaps the extent of the damage to the global economy will be as bad as, be ready, the 1920s depression, not 2008 recession or financial crisis. So we're going beyond the financial crisis, going into economic crisis, social crisis, and political crisis. So the virus began in the biological sphere, sort of spilled over into the socio-economic and financial spheres. And the difference between what we face now and what we face in 2008, 2009 is that we do not have a financial crisis. We have an economic and social crisis, biological crisis that has financial implications. Big difference. We know, and the global financial institutions know how to manage financial crisis. They don't know how to manage the type of crisis that we have, which for the first time, we see governments across the globe force majeure shutting down the supply side of the economy, from production to services. And that is a relatively new phenomenon, which means global GDP, when the crisis settles down, will have to find a new equilibrium. It has to find a new way of operating. We are not going back to the normal, so to speak. We have to explore, identify a new equilibrium, and that's an important point from a policy as well as from an investment point of view. If we come to South Africa, if we look at the damage that is done to the supply side of the economy, there are some sectors that we are going to get immediately hurt. We know that global tourism, global transportation, global hospitality, and all the related industries are going to suffer, including, very importantly, the aerospace industry, which does have, for example, a heavy dose of PGM, catalytic converters in them, and the demand for some of our major exports is going to be affected. So we need to think through what this new equilibrium will look like. I sort of hesitate to talk about a new normal because, as we know, normality implies some level of predictability, some kind of stability. Neither stability nor predictability are technically feasible in times of mutating conditions, both biologically as well as socio-politically. So if you look at the global impact, we're going to see a cut in GDP. Where are the likely real heavy damage is going to be on EU. Number one, because they just don't have unity of purpose to get something going. Obviously, China will be affected. For the first time, China presumably will hover around the type of growth. If it's not negative, definitely it will be in numbers that they've never seen for 30 years. And that means demand on their side for a lot of our export is going to suffer on the mining side. A very important implications, which is both positive and negative. In the short term, China will have to get away from the dispensation that they were the manufacturing factory of the globe. More and more, the world is going to rethink that style of global manufacturing, which means a lot of countries like South Africa, a lot of regions like Africa, they're going to start examining opportunities for manufacturing for the type of industries that we sort of let go because China was cheaper, China got better scale, and you know all that debate. That debate has to be revisited. So part of the mutation that I referred to is also an ideological way. A lot of things that we had been socialized to accept, we have to now unlearn and start building our manufacturing base in the country. So these are some of the positive stuff that will come. If you come to the national state, our GDP, without a doubt, on the back of preconditions that we had, downgrade that we experienced, and the impact of the virus, we're going to go into a recession. There is, in my view, no way of getting away with it from it. Whether we'll have a -1% as some say, -0.5% as the Reserve Bank predicts, and watch this board, they will revise their projections down. Everybody will. So be prepared for a 3% contraction up to 6% in that range as the situation unfolds. And that is quite severe for economy that had severe preconditions to begin with. To wrap it up, and it's very important, and hopefully we'll come back to it, there is also a lot of silver lining at the end of this dark cloud. We see, and I definitely foresee that when the situation settles down, we're going to see a surge of investment opportunities in key areas related to health and hygiene, related to food and food processing, related to a lot of logistics and so on and so forth. So if we look beyond the immediate dark cloud, there is a lot of opportunities that I hope, as part of our response to the COVID-19, the country will begin to conceptualize not an immediate 3-month, 6-month response, but a 3 to 5 year response that will incorporate a lot of these investment opportunities that for our local and international capital market, they will be good candidates for new investment opportunities. I'll stop with there, Mesh, and we can come back to this if there is interest.
Thanks very much, Iraj. That's, I think, very informative. Before we move on to some debate, I'll hand over to Kgopotso for his input around capital markets, both globally and locally, and the challenges we face as a country. Kgopotso.
Have been addressed. I'll start by looking at the implications for global financial markets broadly, and in particular South Africa, but I'll try to most of the time give this discussion an international slant. Key questions that I think I'd want us to try to answer as at the end of this webinar is the effect of COVID-19 on the global economy. Is it going to be transitory, or will it have a long-term trajectory on the global GDP growth as well as asset prices? Secondly, is the fiscal and monetary stimulus sufficient to halt the current deterioration in global financial asset prices, as well as the deterioration in the economy, and possibly look at some strategies that one can follow to take advantage of this? I've put my discussion broken it down into 4 key areas. I mean, I'll just give a global investable universe panorama, look at latest market developments, and hone in on some topical issues in South Africa, and apply my global macroeconomic and cross-asset framework to try to answer these key questions. If one has to look at where we are currently, we are talking, I mean, Iraj talked about the global economy contracting quite significantly. Going into this crisis, the global GDP was around 87 trillion. Currently, as at the beginning of April, we're sitting at about $85 trillion globally. Assets, the investable universe, excluding derivatives, sits at about $238 trillion. I think these numbers are important for perspective. Fixed income comprises about 52. That excludes the assets that are held by central banks, and there's about 70 that makes up equities. Just to break down the fixed income market, to give it a slant on the debt side, at the moment, government bonds make about 32 trillion of the global fixed income investable universe, with the rest of the 14 trillion being in the credit space. So that sets the tone if one has to look at the global GDP as well as the investable universe panorama. Market developments that we've seen lately, I mean, we've seen a significant adjustment in risk premiums across all asset classes. With that, we saw the market caught by surprise. I think the extent of the adjustment of risk premiums was not expected to be of this quantum. And that led to a decimation in liquidity in both safe haven and risk assets. And that decimation in liquidity led to liquidity migrating to the various financial sectors. We saw US equities mainly trading. If you wanted liquidity, you had to get that during US trading hours, and same applied to the bond markets. And with the decimation in liquidity, we saw extremely volatile action, price action, unprecedented. We've seen the VIX, which is the benchmark index for measuring volatility across financial markets, hovering around the 70-80% level. And that has started to subside over the past few weeks, but it still remains relatively high. I'll get into where we see it going forward. With the volatile price action, we've seen dislocation of intrinsic value versus market value of some of the assets, particularly risk assets. However, we've seen the bond market continuing to be pegged to monetary policy, and as a result, one becomes very difficult to make a call as to whether fixed income assets offer a value here, but definitely there is an argument to be made for risk assets, in particular debt and equity instruments. And on the back of that, we've seen quantitative easing on an unprecedented scale. I mean, the amounts of money that have been put into the market by central banks are quite massive. I mean, I won't go into the figures. I mean, the figures are public knowledge. But what that means for the markets, and in my opinion, I think we will continue to see accommodative monetary conditions for an extended period of time. I mean, are we looking at periods similar to what Japan is going through now? I don't think so. I think the rest of the world combined has got a lot more resilience than Japan has experienced over the past 25, 30 years. They haven't been able to get out of this rut. We have seen continued open market operations through quantitative easing, through administered rates. The US in particular, I mean, applying the IOER and the overnight reverse repo, taking assets out of the market and pumping liquidity. The big question then is the liquidity that the central banks and monetary authorities worldwide pumping into the market, is it going to pass through into the real economy? Looking at 2008 taught us a few lessons. There wasn't a lot of pass through into the real economy. In fact, we just saw a lot of that money going into the financial markets and leading to reflation and increase in valuation. I mean, equities, we saw equities rally to new highs. We saw credit spreads tightening, but there was, of course, a lot of differentiation. A lot of the credit spreads that tightened were those of the developed markets. And when it came to emerging markets, we saw tightening spreads, but the market, tightening of credit spreads, but the market was very, very cautious in observing some of and pricing some of the idiosyncratic risks. The final point under the latest market developments is just to look at the decline, the impact of the decline in global GDP on the financial channel. There are some signs of strain on the financial channel now, but it still remains functional. The credit markets in the US, we've seen certain sectors starting to pay up for money, but however, the credit markets were still functional. Asia Pacific, quite upward pressure. And if one looks at some other liquidity measures, we saw a little bit of pressure there. Let me just take an opportunity to take a step back from the global financial landscape and look at topical issues in South Africa. I think the first topical issue that I would like to touch on, that is on everyone's mind, is the credit downgrade of South Africa. I mean, it was not a matter of whether or not, it was a matter of when this happens. I mean, the country has been going through a lot of problems, kicking the can down the road. But if one has to look at empirical evidence, data shows that it takes about 7 to 8 years on average to regain your investment grade status from an investment downgrade. And there are countries that have done it a lot sooner, and there are those that have taken more than a decade. And in my opinion, I think South Africa will be amongst those countries that take longer than the average. The reason I say that, I mean, broadly, there are a number of factors, a classification of factors that lead to downgrade. I mean, economic deterioration, we are going through that. I mean, I think Dr. Phosa did mention that COVID-19 was a catalyst. It found us under tremendous amount of pressure. And if one has to look at the second categorization of factors, unsustainable macroeconomic imbalances, we are going through quite a little bit of that at this stage. And I mean, broadly speaking, if one has to look at those, there was very little chance that we could maintain our investment grade. And going forward, if one has to look at additional problems, I mean, reducing the public sector wage bill, cutting state spending, restructuring state-owned enterprises, that still plays into a weak investment grade and justifying our move into junk status. The second topical issue that is of international significance is the dynamics of the oil market at this stage. I think everybody's aware of the deal that was reached over the weekend. My opinion is there is still sufficient demand destruction from the economic slowdown that is still going to tilt the oil market to the downside rather than the upside. The supply cuts that have been agreed over the weekend, I think, are not sufficient. I mean, estimates in the market at this stage, we're talking about 30 million barrels per day of demand that has been taken out of the market as a result of the lockdown globally. And the cuts that were agreed upon over the weekend are nowhere close to that. So the oil price remained favorable for emerging markets. We are a net importer of energy and oil in particular, so that should put a lid on inflationary pressures and inflationary expectations. So against that backdrop, trying to answer some of the questions that I had raised earlier, I mean, looking at the global macroeconomic assessment, what do we expect? We expect GDP and inflation to remain subdued. The current trajectory of GDP should continue downwards. I think the jury is still out there how much the contraction is. And then the liquidity conditions, we think, I'm of the opinion that liquidity conditions will remain accommodative. However, accommodative liquidity conditions would not necessarily translate into a robust financial channel. I think there would be some sectors that would experience the liquidity constraints and pressures more than others. And if one has to look at emerging markets in particular, I think differentiation is going to be a major player. There will be opportunities to raise funds, but sector-specific and idiosyncratic risks will be right at the forefront of investment considerations. What is priced in at the current levels? We have seen the equity markets fall quite significantly. We have seen fixed income markets yields collapse drastically. We think volatility is going to remain part and parcel of the financial landscape over the next quarter or two, but continue to decline. Yield curve dynamics, globally, we anticipate the rapid rate at which central banks and monetary policy authorities are lowering rates could possibly lead to steeper yield curves. We anticipate the short end to collapse far much quicker than the long end. What does that mean in terms of valuations for the debt market? We think, I'm of the view that the consideration of idiosyncratic risk is still going to be central. There's not going to be blanket flooding of cash into the market looking for opportunities. There is going to be serious distinctions that will be drawn based on balance sheet constraints and other financial indicators. If one has to look, what sort of strategies can one, from an investment management point of view, I mean, your portfolio generates returns in two key ways, through capital appreciation as well as income accrual. Against the backdrop of the rapid decline and repricing of risk premiums, I think price momentum still remains a very good opportunity for one to enhance returns and to a limited extent value, given that there has been significant dislocation of intrinsic value versus market opportunities. But volatility and momentum still remain the key drivers of returns. And I think going into the first quarter of next year or late Q4 this year, we might see value, quality, and carry starting to come into the market. What are the risks to that scenario? We still remain worried on a global level about the expansion and bloatedness of central bank balance sheets, EMs, high debt to GDP ratios. I mean, if one has to look at South Africa, it's been a triple whammy. I mean, credit spreads widened as a result of the downgrade. Number two, the currency weakened, so your liabilities relative to your GDP balloon. And finally, we anticipate GDP to shrink or contract rather, for a lack of better way. So for South Africa, the risks are very, very high. And that also would apply to South African corporates. And against this backdrop, liquidity disruptions become a very, very real risk. We've seen over the past 2-3 weeks, US equity markets have gone into log limit more often than I have seen over the past decade. And with the one-sided risk, everybody moving into safe haven assets, that has created embedded asymmetric risk to global asset prices. I'll leave it there for now, and I'm quite happy to take any questions.
Thanks very much, Kgopotso, and indeed thanks to everyone for the input. We have a number of questions, so I'll work my way, I think, sequentially, starting with questions for Dr. Phosa. Matthews, the first question that was levied at you was, firstly, what your view was on President Ramaphosa managing this crisis, which I think you hinted about, and further to that, whether this could be a turning point for the ANC, both as a party and as leadership in government. Sorry, Matthews, I think you're still muted.
Am I muted?
You can go ahead now.
Can you hear me?
I can.
Yeah, I was saying, thanks for the question. If it was 2 weeks ago, I would have had difficulty answering it, because the president was seen as being very indecisive and weak. But somehow he woke up from his sleep. It took a virus of this nature to wake him up from his sleep, ironically, because he became very presidential, very statesmanlike, very decisive, and pulled the nation behind him, black and white, of all religion. So he's very strong now. He's riding the top of the waves, and the nation is respecting what he says, and when he speaks, everybody listens. Nothing is perfect in society. You still have loose ends this way and that way, but on the whole, he's in charge, and he's got the support of the nation behind him. Now, if you look at that question and the answer to it, which I've just given, and you look further into the ANC, before, 2 weeks ago, the ANC was riddled with internal contradictions, which I don't think they've gone away. They have gone to sleep. The ANC is facing what we call a National Consultative Conference. It's really an oil check. It doesn't change leadership at all. It's an oil check of whether or not the president has performed since the last conference where he was elected. The media is making noise that, listen, he'll be removed and all these things. Let me assure all of you, it's not going to happen. If at all, he'll be parrying blows on this and that, but he's so strong, he'll go through that, and he stands the chance of having a second term if he keeps that momentum of being seen to be strong and decisive.
Thank you, Matthews. The second question is also for you, from the leadership of one of the large property groups in South Africa. It's quite a long question, but I think in essence, what the question hones in on is that there are several suppliers that are not paying their rentals. There's several suppliers that have decided against the president's wishes to honor the payment of that, which has led to a significant flow down and effect on mall owners in our country and property, both listed and unlisted property players. How do we deal with that? Because there are still certain entities that are able to process their businesses at this point in time. So the question is that, they still have income, they're still capable of paying. We understand not everyone is capable of paying, but what does one do in this instance? Does the state intervene and ensure some of these retailers pay their rentals, because the knock-on effect means that the mall owners and property owners are being hit quite significantly by this. And as you know, the property sector is a very dominant sector in this country, and it's taken a significant blow. But I guess the question is levied as whether the country, the president and the government can do more to assist.
You see, Max, from the properties side point of view, the issue we're dealing with here is some guys refusing to pay rental. And if you look at the president's last speech and look at it very closely, he specifically called on tenants to pay rental. And by implication, all those who owe money to in supply chain to honor their obligations. He was very clear, and I think the affected companies should find a way of engaging with those suppliers. The president said no one should use force majeure as an excuse not to honor obligations. He was very specific about it. But I think the property owners and others affected by this disrupted supply chain have raised the issue. I will take it upon myself to raise it again with him and say, listen here, Mr. President, they're not listening. They're being opportunistic. They're using force majeure. In the case of one of the companies where I sit on the board and own shares, the logistic company, name not to be mentioned, my CEO was telling me, they're telling me him it's force majeure, and it's wrong. I'm happy the president spoke against that. And let it be clear, they're not right, they're wrong.
Thanks, Matthew. Iraj, I think you can weigh in here. I think particularly given that you sit as chairman as one of the listed property companies, but maybe just more from a sector-specific perspective, what you've seen as well.
I think we see the same type of pressures, and listed property sector at the moment is under pressure. Of course, it has to play its part in discussing and making sure that especially the SMEs don't suffer too much. One of the elements of this particular question relates to the fact that big metros, Johannesburg, Cape Town, Durban, they haven't really come to the party to work with the listed property in terms of rates and taxes, that they make some kind of arrangements. Of course, we have to be very careful that the domino effect doesn't take us into more of a recessionary pressure. Municipalities have to pay their salaries of their staff, their suppliers, etc., etc. So I understand there are limitations, but from Fortress, where I have some insight, we are obviously working with our management is working with the tenants and trying to find a way that would assist the ones that we can assist, but at the same time, it's quite correct that the big ones have to pay their rents in order to enable us to work together to assist the ones that are vulnerable. So we cannot have a broad brush for everybody. We've got to work together, and really the hallmark of this crisis is collaborate, coordinate, and be real, because we are on it together. So that would be what I would say from that point of view.
May I say something more?
Yes, Matthew, please.
Yeah, but in case in the next few days the government makes a softening of opening up, I don't think we should make exception. There must be one rule: everybody must pay and honor their obligations. Full stop.
Yeah. Yeah.
And I think, Matthews, that message needs to become clearer. And the retailers need to listen very carefully to, I think, the president's voice on this. And there has been a request by some of the people on this call that you please take it up with the president. And I think there's a number of both retailers on the call and landlords as well, Matthews.
Raj, I'm your co-fighter on that one.
Okay.
Thank you. Matthews, another question to you before I move on is that the DA has come up with their own smart lockdown plan. And, one could argue that the DA is always available for an alternative. But is this just, sort of politicking? Or do you think that the president hasn't considered other political parties in his views and in the policies that he's put in place for now?
But I made passing reference to the DA. The president did consult all political parties, churches, organizations of civil society, business formations. He did. Give him credit for that. The DA, as an opposition party, is entitled to make an input on the way forward. They call it soft lockdown. I think they should be listened to, like every other party must be listened to in a democracy. And let's try and take the best out of the noise we hear. One should not dismiss the DA's voice. I think there's a lot of merit in some of the things they say.
Thanks, Matthews. I think that was very helpful. Iraj, I'll hand over to you. We have a few questions for you as well. I think the first is around what your view on long-term inflation risk is over the next 5 years for the country.
I think it's an interesting question. At the moment, all indications are that the risk for the next few years is not inflation, is disinflationary processes. Yes, we hear all this injection of liquidity, 2 trillion, 3 trillions. All of that is really a fraction of the damage that is caused to the economy. There is no consumer demand. Look at South Africa. At the moment, we had high unemployment. We're going to have at least a quarter, a third, if not half of our jobs in the tourism going. So that demand will disappear. Other SMMEs and others will suffer. A lot of industries will be under pressure. All of that means a cut in actually disposable income, which means pressure domestically on demand is going to be lower, not anywhere close to what we are used to, and internationally the same. We're going to see downward pressures, and my own nightmarish dark scenario, which I hope is not the base case, is when we actually go into a deflationary pressure, deflationary zone. But definitely we are in this inflationary for the next few years. We see the price of oil under pressure. We see price of commodities. We see oversupply and shortage of demand. So I would suggest for the next 3 years, inflation is not going to be our enemy, so to speak, to worry about, but we got to watch the disinflationary process. And that means not only interest rate cuts that the Reserve Bank has done, in my view, still not enough. I would have liked to see 2.5% to 3% in the last MPC, but there's going to cut again. There is no doubt in my mind. But in addition, but that addresses only part of the society, the part that is integral to the formal monetized or financial sector. The section of our economy that is outside the financial sector is what we need to worry about, and the worry is, or the task or a strategic objective has to be, how do we get money into their hands? Bearing in mind that a lot of them don't have bank accounts. A lot of them are dependent on welfare payments, literally cash transactions. So that's a challenge that we have. We need to be much less concerned about inflation, far more focused on arresting the disinflationary process, which requires putting spending capacity in households' pockets, so to speak. And that requires both monetary as well as fiscal interventions. On the fiscal side, and I don't want to drag this answer, one of the key shortfalls, one of the fault lines that we have is our municipalities are not up to task. That is where our people live. That is where help should be rendered through them. And therefore, the national government keeps centralizing everything, which means it doesn't reach out to the population where communities are scattered around this vast country. So again, we need to think of a blend of monetary, which means interest rates and credit and the banking system, as well as non-monetary, call it fiscal interventions, but that is where our institutions are not clean enough, they are not efficient enough, and if you put money in their hands, corruption and abuse will happen and people will not suffer. So we have a challenge here, but all of that means worry about disinflation, don't worry about inflation.
Thanks, Iraj. We have a number of asset managers, both domestically and internationally, on the line. And this question comes to you from one of the asset managers locally. Rising unemployment and rising deficits were a problem before COVID-19. We're now facing a deep, deep recession in South Africa. GDP is at negative 3%, even more potentially. Unemployment post-COVID will be at record levels. How do we get our economy back on track? Are there credible plans? Is the IMF bailout a real possibility now? The president wants to avoid that, but do we really have a choice as a country?
Three questions. The last two, easier to quickly deal with them. Is there IMF inevitability? Not necessarily. Only if we get into balance of payments problems, IMF becomes a potential. But we are far from that. And what is the value of IMF? IMF gives you cheaper money than otherwise. But the South African capital market, as we know, is sophisticated enough, deep enough, and able enough to potentially borrow at the same rate, if not better, than what the IMF would do. So I think IMF has changed over time, and its extent of support for South Africa, for me, remains doubtful, not from a political point of view. I know there's a lot of ideology, especially within the tripartite alliance. That's not where I am. I'm talking about the technical point of view. We have to see how credible the extent of support that the IMF can offer. Can we match that? In my head, I think, given the sophistication in our capital market, we should be able to. But I'm not averse to it. At the moment, we are not there yet. We might get there. Is there a plan? I don't know. I'm hoping that what the Minister of Finance today said will culminate in the cabinet tomorrow, putting a response together, not a stimulus package. I personally don't like that term. We need to talk about COVID-19 response package, which is a much more nuanced and sophisticated and possibly more complex answer to stimulating the economy. No, we don't need to stimulate. We need to respond to a crisis which has wiped out a lot of our production capacity and changed the game globally and ideologically. Therefore, what's the best response? We'll have to wait and see what the cabinet will come up, and then we can assess it. Then coming back to the main question, we're starting with high unemployment, high disparities of income and poverty. Is there a way to dig ourselves out of the hole? The answer is we have to think differently. We have to literally, with the same determination and with the same level of political leadership that the president has shown in response to the virus, I would like to see him in parallel respond with the same type of determination to a response package to the post COVID-19. In other words, how do we restructure our economy? How do we fast track investment in some areas that we know is going to be the new investment opportunities? And again, I hinted at some, and luckily South Africa, unlike many other emerging economies, and definitely a lot of other neighboring and African countries, we do have a modicum of capacity in manufacturing. We can scale it up into a whole range of areas that would create jobs and create, to some extent, mitigate the response, the damage that COVID has done. Into agri and agri-processing, food production, again, there's a vast opportunity that we have. Instead of keeping ourselves busy with, should we expropriate without compensation, should we white monopoly or black monopoly, that nonsense must stop. We should have a national campaign or national project response to this very question of how many jobs, how quickly, how sustainably can we create, where are our comparative advantages? And I would say in the manufacturing sector, in agri-processing, in beneficiation, in petrochemical, in water supply, and all of that in the context of not South African national boundaries, in the context of our regions. And in that, there are a lot of investment opportunities, a lot of job creating opportunities. All of that will go to, if not completely, but to a large extent, respond to the crisis that has created so much more devastation and is bound to do that. That's the line of thinking that we should have. in summary, stop pushing for, as business, we have to also be part of that. We cannot just say government must do government. I'm suggesting we all have to get together as a nation to say, where are the opportunities? Where can I, in my neck of the wood, create more jobs? What are the propositions, and how do we think, not the old way? The old way is gone. We got to think new industries, new equilibrium, new opportunities, and rebuild the country. For example, if we deal with the water issue, the urban infrastructure issue, the energy issue, not talk about it, deal with it. In each one of them, you will see number of jobs, you will see growth, new growth, and in that way, we will find the way to respond to the damage of COVID-19. That's my thinking along those lines.
Thanks, Iraj. I think the next question is now moving towards Kgopotso, and obviously, Kgopotso, some of the questions that are linked to a Reserve Bank comment we will not expect from you. But the first question by one of the, I think, one of the South African CEOs of one of the largest REITs here. His comment is, liquidity and capital relief has been made available to commercial banks, which is commendable. We have seen central banks globally inject liquidity into the banking system. Ultimately, the question is whether and how that liquidity can find its way to corporates. Do the banks trap that liquidity? How can we ensure that the corporates are feeling the effects of that liquidity and the easing that provides?
That's quite an interesting question. But if one has to take a step back and look at what happened in 2008, the global financial crisis. The global financial crisis taught us that most of the financial relief in the form of stimulus that went into the global financial system didn't get into the real economy. It ended up in the financial markets, and that led to a significant appreciation in asset prices that we have seen recently being corrected. I'm a little bit wary to say there is a mechanism looking at the number of systems worldwide that can directly impact the real economy, except in the event that there are some supply side initiative, long-term investment initiatives in the real economy, targeting specific sectors and thereby identifying corporates. But the pass-through onto the demand side, I don't see that feasible in the immediate term, unless we go and review the current model of surplus and deficit households and the intermediation. But at the moment, I'm quite wary to say we are going to see that money filter through into the real economy in the immediate term, except if we do the targeted supply side investments that are very industry specific.
Thanks, Kgopotso. Iraj, I'm not sure if you wanted to make a statement on that as well.
Yeah, I think I fully agree with Kgopotso that the financial intervention, whether it's quantitative easing, all of that is got limited flow through. We got to think differently. We got to begin to really think of a response that is based on the foundational parts of our economy. What are the parts that the government or public sector has to do? What are the private sector? For example, if we think of a national response that is built on reviving the urban settlements, the water infrastructure at macro and regional and micro level, and all the related industries, all of that is the type of targeted response that we have to have, which means for those, you have investment opportunities that are productive, they deal with the legacy issues, they begin to incorporate and bring in people, not just in Johannesburg and Cape Town and Durban, right across the country. And if you think that way, for example, for 30 years, in fact, our agriculture sector has been neglected. All the rivers and water supplies and all of that right across from Limpopo to Cape Town. And I've had the privilege of being in this sector. From east to the west of the country, this is just neglected. We've got to invest in those type of very targeted but critical interventions that has positive multiplier effect on a whole host of private sector opportunities. If we go and look at about 5 sectors, water, infrastructure, and remember when we talk about urban infrastructure, what are we talking about? Talking about the cement industry, talking about brick makers, you're talking about door handlers, and we're talking about light industry. So all of these multiplier effects are subsumed in that type of intervention. When you talk about a national water scheme, you're talking about not just big designs of dams and so on, but all the pipe manufacturers, all the gadget manufacturers that supplies into that. So we need to literally get out of the old style of thinking, go to the post-World War reconstruction of Europe. The Marshall Plan that everybody from time to time when it's convenient, they floated. Why? Because the supply side had been devastated and we had to rebuild it, but in not theoretical way, but in a very practical and targeted way. And then leave the rest of it to the private sector to pick up the industries and investment opportunities. Nowhere, I think we got to think very, very unusual in these very unusual times.
Mesh, I'm a simple businessman in South Africa trying to do my best. When I see the Reserve Bank fork out 540 billion rand to the banks, which we appreciate, I have an expectation. And I'll go back to your question, will there be a trickling effect to the corporate? It's a reasonable expectation by citizens of any country. Otherwise, what is the purpose of pumping that money in the banks and they then sit on it and freeze it? Not fair.
Absolutely, Matthews. And I think that leads to the next question to Kgopotso again. Kgopotso, is there potentially a further intervention that SARB or any reserve bank, I guess, around the world could do without going through banks? So, for example, particularly in one of the hardest hit sector, which is a property REIT sector in this market, can SARB intervene and buy corporate bonds or REIT bonds and directly inject liquidity into the market and bypass the banks, in that scenario?
Well, Mesh, I mean, given how sensitive the current intervention is that the bank is currently, I mean, I would rather prefer not to get involved in that one. However, there is a question that I've seen coming through on the question and answer board there with our downgrade. What can we expect in terms of new liquidity influx into SA, even that we are not an investment grade destination, and what tenure? I mean, at the moment, I think EMs look very attractive. You can borrow money in the DMs and go and invest at very lucrative spreads in emerging markets. I mean, we've seen, for example, the Middle East now. We've seen Qatar in the market at treasuries plus 300. We've seen Abu Dhabi at treasuries plus 250. But those are AA rated institutions. So what that means is that there is going to be a significant amount of differentiation and pricing of idiosyncratic risks. I mean, if you can get those sort of returns with less credit risk and with a lot more stability, well, I mean, barring any exposures to of the region to the oil price. But from a credit rating point of view, I think differentiation is going to be a significant player. And also, I mean, from an inflow point of view, we mustn't forget that we've got a significant portion of South African debt that is foreign currency denominated. And as a result, if some investors one South African exposure, they don't have to come through into the rand. They can still buy the South African foreign currency denominated bond, and in that way, they get the credit spread without the exchange rate risk. Because if one has to look at how rapid the rand has depreciated over the past 3-4 weeks, I mean, any investment that you had in rand assets, I mean, the currency depreciation would have wiped it out, and you would have ended up in negative territory. So one must guard against thinking that with a weak currency and attractive yield spreads, you're going to see the flows coming into the country. Portfolio flows, in my opinion, are still going to be focused in hard currency. The exposures are going to be taken in the debt market using dollar denominated and other foreign currency denominated assets.
Thanks, Kgopotso. I think we're going to take two last questions before we close up. The next question, Iraj, I think is best placed to sit with you. This is from one of the largest fund managers, from one of the largest sovereign funds in the world. And the question is South Africa still an investment destination? And why is that? I think, Iraj, if you can kick off with that, and maybe Matthews and Kgopotso could also give us their views.
Yeah, absolutely. I believe for two reasons at a macro level, South Africa still offers a good investment destination. Of all the emerging economies, South Africa is, if not the top, one of the top diversified economies, which is not exposed to one single sector or one single commodity. That's one of the important elements of medium-term risk mitigation. Kgopotso mentioned that Qatar and UAE and so on are double A, yeah, but just watch that space. That can change if the oil price goes another 2 years. Suddenly they have nothing else to hang their hat on, so to speak. Look at South Africa. We've got between agriculture, manufacturing, and I believe manufacturing is going to be on the rise in light of my previous discussions. Services sector, banking sector, tourism, etc. Although tourism is going to be under pressure, but it's nonetheless part of our portfolio of national GDP. And that is the requirement, an absolute economic requirement for medium-term success. How much of that portfolio, diversified portfolio, we will make it marketable depends on what type of response we offer to this COVID-19. And therefore, I like to believe that between government and political leadership that we have, as well as the business leadership, including the investment leadership that we have in the country, which in itself is a comparative advantage, we can now begin to focus on unlocking the capacities and the potential of this diversified GDP portfolio. So that's one reason that I'm very optimistic about at the medium term. I'm not talking about the short term, the next 3 months. I'm talking about 3 to 5 years and beyond. The second reason which South Africa distinguishes itself is, in fact, in our constitutional platform. We are a democratic constitutional democracy, which, again, for medium to long term, is an important underpin for any investor, anybody who buys our bonds. And those two combined put South Africa in a favorable potential. And therefore, I feel very strongly that if as a nation we respond appropriately, we can unlock that potential and use the global liquidity to build what we need to build on the cheap.
Thanks, Iraj. Matthews?
I'm happy I'm coming before Kgopotso because I'm going to say something that is going to make him feel very good. Over and above what Iraj said, in South Africa, we have a reserve bank and a treasury which never do currency manipulation. There's a lot of, they're very dependable and reliable. So if you have that as your anchor, you've got a very good framework within that constitution. And I give our reserve bank and our treasury a lot of credit before and even where we are today. I think they've got a very big role to play. And I agree with you, Raj. We remain an ideal investment destination in all those sectors which are there. Now, those are not going to be wiped out. It's how investors see the opportunities in our situation. And it's our task not to say we look beautiful. We go out to the world and say, come and invest, and give reasons why.
Kgopotso, do you want to weigh in on this point?
I think Iraj and Matthews just summed it up quite well there. But I mean, from a secondary market point of view, if one has to look at equity valuations now relative to the fixed income market, I mean, our equities look relatively cheap versus their peers and versus fixed income market. And I think, I mean, I can talk proudly about guys like yourself, Mesh. I think we are a good investment destination because we've got quite a sophisticated financial system that provides good market access, which some of the EMs don't have. Because much as you have opportunities, market access and access to capital remains very, very important. And your ability to raise money, securitize the debt, have a sufficient investor pool in the secondary market to take that debt up remains very, very important. And the second and final point is, given the sophistication of our market and market participants, I mean, we have good liquidity providers in some of the assets through which the investor community can come through into South Africa. So that is an added advantage too.
Thanks, Kgopotso. I think on that note, there are still several questions, but what we will do is email responses from each of you to those individuals. I'd like to just close off with one last question or comment. It is from a significant investor, both in the continent and internationally, based out of New York, which runs over $270 billion worth of money. And focuses on, they're both a hedge fund and private equity. You know, their statement was simply, we do not see South African corporates enough, you know, and I think this is a huge issue, is that South African corporates have stopped raising capital aggressively internationally. And I think that the premise of this discussion is clear, is that once we go back to normal, we have to find other ways of raising capital and attracting capital to our country. One of those ways is to maintain the old roadshow sort of scenarios that we used to do in the past. And there's certainly pots of capital that we're seeing around the world, whether it's in Asia, the Middle East, or the United States, that are interested in private investments and different types of investments. And so when you look at innovation, I think being one of the key topics and themes for today's conversation, we have to ask ourselves as people who raise capital, how are we innovating ourselves? YW is launching a platform, an application web-based platform to now raise capital from international investors and local investors online. We will launch that in the next 3 weeks. This is, in fact, an opportune time to do so whilst we're all sitting, you know, at home, but still needing to raise capital and preparing ourselves for sort of when the capital markets come back. The last point that I wanted to raise is that we have launched a fund from our side as a responsible citizen, not as a relief fund alone, but as a fund that will allow businesses to accelerate and to increase their capacity and exposure. And we do that to hopefully, in a small part, boost our manufacturing sector in South Africa. And so, you know, anyone that is online, that is in the manufacturing sector, you know, please feel free to look at our website around that. Overall, I would just like to thank Iraj, Matthews, and Kgopotso for your time. I think this was invaluable. I think we need, as South Africa, to speak more about how we're going to navigate this crisis and what's going to be left of our country once this is all done. No doubt, I think the crisis has created a level of patriotism that we've not seen in a long time, and I think is much welcomed by both us as a country, but also the comments that we're seeing from international investors is it's about time South Africa started believing in themselves. So with that, thank you very much, gentlemen, and thank you all for listening in.